The word alternative investment may conjure up images of investments that are only available to huge institutional investors, or at the very least investments that are too complex for the average investor to comprehend. This is a popular notion that may have been partially true until recently. However, due to recent regulatory reforms, a much broader audience now has access to this type of investment, and the results are far more favorable than you may imagine. Precious metals, oil and gas, venture capital, hedge funds, and real estate are all examples of alternative investments or alts. In the previous video, we went through the possible benefits of alternative investments and how they differed from standard asset classes, and provided you with a comprehensive list of alternative investments to look into. Stay tuned as we will go through some more of these alternative investments. Before we get into the video, don't forget to drop a like on this video and subscribe to the channel if you haven't already. Make sure that the post notifications are turned on so that you never miss a video from us. Without further ado, let's dive in. Fine arts. Artwork and collectibles are a type of alternative investment that needs a great deal of market expertise, as well as patience. The key to investing in artworks and collectibles is forecasting if and how they will appreciate in value over time. Because it's difficult to predict demand and appeal 20 to 50 years out, this investment is a gamble if you don't know what you're doing. Artwork and collectibles are relatively illiquid and likely to lose value due to counterfeiting and normal wear and tear. So if you're going to invest, make sure you're getting something you'll adore forever. Fine arts can be a solid investment because the price swings in the art market have historically not mirrored the ups and downs in typical stock and bond markets. Of course, one of the biggest advantages of art as an investment is that if you buy what you like, you can always enjoy it for its beauty, even if you don't get a lot of money back. If you don't want to buy art outright, art finance through an investing platform like Yield Street is another option. Fine wines. Over the long term, fine wine and other rare liquor investors should expect to earn a stable return of 6 to 15% every year. The price of specific vintages, as well as great wines in general, varies from year to year. However, as supply becomes stored, prices of wines from the most sought after vineyards and vintages tend to rise. Wine collectors and connoisseurs are notoriously picky, so investors must stay on top of things like which vintages are worth investing in. Because collectors prize wines from the Bordeaux region and other regions of France, they produce more consistent returns, although many Burgundies, Italy's Super Tuscans, Spanish Reds, and California's Cult Cabernets are also attractive investments. WinePrices.com, for example, keeps track of individual and aggregated wine costs. Even with some of the most costly wines, you'll need to buy a lot of them to get a good return. To preserve the wine in top condition, it must be kept in a temperature-controlled setting. Wine that has been poorly preserved can be detected by auction bidders. The bottles should be kept between 55 and 58 degrees Fahrenheit, 12.7 and 14.4 degrees Celsius, with a relative humidity of 60 to 75%. Commercial wine coolers cost several $1,000s, but there are companies that will keep your wine for you. Finally, to satisfy sensitive auction purchasers, investors should insure their collections and retain meticulous purchase records. Commodities, metals, crops, cattle, and other commodities are examples of tangible assets utilized to manufacture consumer goods. Cotton, sugar cane, and coffee are examples of soft commodities that cannot be held for lengthy periods of time. Commodities can be purchased and sold directly on the stock market or through derivatives such as futures and options. Commodities are another excellent alternative investment because they are one of the only asset groups that profit from inflation. Commodity prices naturally rise when demand rises, helping to protect against inflation. And the commodities market is one of the most volatile, as unanticipated natural disasters and global events have a direct impact on pricing. Consider the case of crops. A drought for 1 year can lead the price of a specific crop to spike because scarcity causes an increase in demand. A large excess the following year could cause the price of that commodity to plummet drastically. Commodities are often better long-term investments than short-term investments due to their unpredictability. Food prices in grocery shops. and petrol prices at the pump surged as a result of the economic uncertainty that followed the 2008 crisis, implying that commodity prices rose as well. Commodities such as oil, corn, and gold rose considerably in 2010, resulting in impressive returns for investors who purchased commodities in previous years. Individual investors can take advantage of rising commodity prices by investing in exchange-traded funds, ETFs, which are essentially mutual funds that buy commodities or invest in commodity-producing companies. Rather than focusing on one commodity, the safest ETF buy a variety of them. ETF can help to reduce the risk of picking which commodities will rise and fall at any given time. Coins. Collectible or numismatic coins are the second type of coin used for investment. These coins are valuable not because of their precious metal content, but because of their rarity. Morgan dollars, walking Liberty half dollars, and some buffalo nickels are popular collecting coins. The condition of a coin, the mint market bears, and the year it was issued are all elements that determine its value. Coins in mint condition are always more valuable than those that have been badly worn. Coins from certain years had fewer mintings, making them more precious and uncommon. Because the coins were minted with overdates when the 1917 die was impressed with a 1918 hub, some 1918 or 7D buffalo nickels could be valued at as much as $285,000, for example. The rarest coins in the coin market can yield significant returns of up to 100% of their value in a year, but more slightly uncommon coins might yield only modest returns of up to 0% in a year. When buying investment coins, look for a reputable vendor and inspect the coins thoroughly before purchasing, as there are always fakes circulating. Now, let's look at why you should consider alternative investments. Every investor who has been in the stock market for a long time has certainly had some large successes and some big losses. Anyone who is nearing retirement or has already retired has felt the pain of watching their portfolio decline, often dramatically. Investors pursue alternative investments for a variety of reasons, one of which is diversification. An investment that is uncorrelated to the stock market is one that does not fluctuate in response to market ups and downs. Many investors believe they are diversifying their portfolios by holding rates or other publicly traded alternatives, only to discover that they are just as volatile and don't offer much value. What you're getting in most public investments is a paper asset, the discounted value of future expected earnings. You don't really have any possessions. Even if you own a rate, you're still a long way from putting your name on the real estate property's deed. When you purchase excellent fine wine or arts, you are purchasing the bottles of wine or the oil painting directly. If you purchase a rental property, you own it outright. You have a lien on a property if you buy a mortgage note. Alternatively, if you invest in a private fund, you will typically have direct ownership of the assets that they acquire. Alternative investments can potentially offer significant tax advantages. Because of the structure of many alternative investments, you get to keep more of your profit. You become a part owner of the fund or syndication in many private alternative investments, and the tax benefits are passed on to you directly. Pass-through depreciation and long-term capital gains treatment are the two major tax benefits. Depreciation expense, a non-cash expense, is deducted from net income by many real estate funds or syndications, lowering taxable income. Depreciation or depletion tax treatment for oil and gas investments is quite advantageous. With this, we have come to an end. The content in this video is for educational purposes only, and hence should not be considered financial advice. All the financial decisions should be made after doing your wide-spectrum research. If you have found this video useful, make sure that you like this video, comment on your thoughts, and also do not forget to subscribe to our channel to stay updated about the latest videos. Until then.